You know what's the problem in this, this whole play, and it's kind of the iceberg of what is the tip of the iceberg of what is happening in the whole market is that you have a bunch of people because they have been always, using the same model, the same processes, the same strategy. I'm talking about mainstream media. I'm talking about the big guys with the big pockets, and it's like a system. And this system, using also technology, the algorithm, are kind of working in tandem, working together, hands in hands, in order to make sure they will get richer and richer. But when you actually get to the bottom of the reality, what they're not telling you or what they don't want you to believe is the reality, which is the case, it's totally different. And it's the exact same thing with AMC. Because even if the share price is tanking, which I believe has not solely anything to do with the short sellers only involved into AMC, but short sellers also in general, because the whole market is just into the trash now. Everything is just into the toilets. We talked about that many times since last week. But interestingly enough, when it comes to one of the top hedge funds, literally the best hedge funds known so far for the last 20 years on Wall Street, is also losing clients. Yeah, clients. Secretive hedge fund Renaissance Technologies reportedly sees $15 billion in outflows despite double-digit performance. This is Jim Simmons, the CEO and founder of Renaissance Technology. We already know that they tripled, back a couple of months ago, they tripled their positions into AMC. And these guys are really basing their strategy into data analytics, technology. So it's like kind of what Citadel is doing, right? So they're saying that they saw almost $15 billion in outflows over the past 14 months. Even though the fund delivered double-digit returns for its three public funds in 2021. So the big question is, how in the heck a big company like this, even with double-digit, still returning, making good returns, being satisfying for the clients, it's still seeing those clients taking the money and running out, running off, running away? Well, because people don't believe what is happening now with hedge funds, and the way they manage money is actually going to continue to be as it used to. Because originally, hedge funds were supposed to be a company that when things get crazy like this, when you see bloodbath everywhere, when the market is tanking, where there is uncertainty on the markets, you go there and you help them weather the storm. That's why we call them hedge, a hedge fund. But they've grown so big, they've grown so high that now, so much that they now became monsters. So when you link this whole thing with what is happening with the meme stocks, as they call it, with AMC, GameStop, and the other stocks, it's literally like, okay, if in 2021 the market did what it did, in 2021, 2021 started here, and boom, the market gained 40 to 46%. This is the Nasdaq. The market did pretty good in 2021. So does it make sense for me to take my money and go see somebody, go give it to a professional, an expert, if by just dumping that money into a regular ETF, a regular index, or a regular mutual fund, I will have done better than they did? So they're thinking, well, does it make sense, especially with everything else going on? So it's not a coincidence that we are hearing that almost 450 hedge funds closed doors last year in 2021. It's not a surprise that a bunch of hedge funds are returning money to the clients. It's not a surprise that we're hearing that a bunch of hedge funds are now returning the money to their clients because they are shifting strategies. Instead of short selling, they're now going into buying stocks long term, exactly like you and I, our retail investors, are doing. So bottom line is, If even for best hedge funds like this, the money is going out, why do you think is going to happen to the little guys, the hedge funds that have like 6,000 shares shorted into AMC, those that are not as big? Because when clients take money out, it hurts you. You have to go to the bank in order to get that collateral, but the bank will tell you, hey, it's going to cost you a lot more, but you are, bleeding on AMC and GameStop. So what do? Either you close doors, or you return money to the clients, or you shift the entire strategy. So based on this, I'm expecting things to get a lot more worse for the little short sellers into AMC, because those are the guys we want to see fall first. Those are the guys we want to start covering, because in the process, when they do, man, they create the whole chain of command to go down. Like, okay, I buy, boom, gamma squeeze. They get squeezed out. The price bump up, 25, 30, and then boom, another covers. It goes to 50. By the time it goes to 50, next thing you know, FOMO is here, day traders are here, everybody is trying to chase the pump, and boom, we go and we have a new all-time high onto the play. And we get to another triple digit or maybe 4 digits when even the big guys on the top of the short selling chain cannot just continue to sustain his position, and also decides to get out at an even higher price, bumping, this whole thing to the moon, definitely. So if you ask me, it's just a matter of time. It doesn't matter what media will say. It doesn't matter how many articles posted out of the Motley Fool, as you can see here, but when you know, so you already know.